Today we'll be presenting the Clear Channel Communications LBO.
LBO timeline. 2006, Clear Channel Communication hired Goldman Sachs in October to explore strategic options. November 16, 2006. Clear Channel announced plans to go private, being bought out by Thomas H. Lee Partners and Bain Capital Partners for $18.7 billion. The transaction was just under a 10% premium above its closing price of $35.36 a share, valuing the company at $37.60 per share. Shareholders ended up rejecting the offer as they thought it was undervalued. September 2007, shareholders agreed to sell company at $39.20 per share. January 2008, Federal Communications Commission approved the deal. February 2008, the Antitrust Division of the Department of Justice signs off the deal, providing radio stations in 4 different cities or so. March 2008, the deal was delayed due to litigation between the private equity firms and the banks. July 2008, shareholders agreed to the transaction, selling at $36 per share due to credit crisis and a weakening of the economy. At this point, Clear Channel Communications is acquired by Clear Channel Media Holdings.
Clear Channel Communications was founded in 1972 by Larry Mays and B.J. McCombs. By 1995, Clear Channel owned 43 radio stations and 16 TV stations. This growth was due to relaxed radio ownership rules and the Act of 1996. Clear Channel Communications then bought billboard firm Eller Media in 1997, with following purchases of outdoor advertising, radio, and TV companies. Clear Channel then acquired Chancellor Media in 1999, and in 2005, Clear Channel split into 3 separate companies. These companies were Clear Channel Communications, a radio broadcaster, Clear Channel Outdoor, which was an out-of-home advertising, and Live Nations, which covered live events. Private equity participants. Bain & Capital was founded in 1984 by partners from Bain & Company. This firm specializes in private equity and venture capital investments, with its earliest notable venture with the company Staples, in which they reaped a 7-fold ROI. Bain & Capital is currently sitting on $75 billion in assets. The second private equity participant was Thomas H. Lee. Thomas H. Lee Partners was founded in 1974 by Thomas H. Lee. Since inception, this firm has created 6 notable funds. This firm is also ranked one of the top 300 private equity firms based on funds raised. Currently, Thomas H. Lee is investing from their 6th fund, currently estimated at $10.1 billion. Banks involved. There were 6 major banks involved in the LBO transaction, led by Citibank. Collectively, the banks agreed to provide $22.1 billion in financing. The banks would receive $400 million in fees. Unfortunately, as the economy crashed, the banks feared a $2.7 billion loss. With this fear, they tried to hold back the money they agreed to give to the equity firms. Clear Channel and the equity firms then filed a lawsuit against the banks. With a termination fee of $600 million, along with the fees for the lawsuit, the banks dropped their countersuit. Rationale behind the LBO transaction. Clear Channel was growing rapidly in the early 90s. With a lot of deregulation in the industry, the business had more freedom to grow. Also, private equity firms viewed this LBO transaction as lucrative. First, Bain & Lee believed the company was undervalued. There were many divestiture opportunities in radio and TV assets. The industry had showed steady growth, and in the industry there was low cost of capital requirements.
Now we are going to look at the funding of the LBO. The buyout consisted of $17.9 billion of Clear Channel share purchase. The agreed price was set as $36 per share. On top of that, the transaction included $6.5 billion of assumed debt, and the total cost of the buyout totaled $24.4 billion. In order to get funding for the acquisition, the private equity firms used a reverse merger strategy. The strategy consisted of creating a new company called CC Media Holdings that would obtain equity financing alongside with a subsidiary called MergerCo that would handle the debt financing. Once Clear Channel acquisition was completed, it merged into CC Media Holdings with merger code to form one unique entity. As part of the deal, the old Clear Channel shareholders received in exchange for their stock a combination of cash and shares of CC Media Holdings. The total number of Clear Channel shares that could receive those shares had a ceiling of 30% of CC Media Holdings equity. The terms of the amended merger agreement also stated that no shareholders of old Clear Channel could get more than 11% of the total 30% of CC Media Holdings equity. Financing. The financing was handled by 6 banks led by Citigroup Incorporation to provide the LBO with $22.1 billion. The banks retained $400 million in fees, and the engagement involved a $660 million breakup fee. The total debt post-merger was composed by $15.6 billion of senior debts, representing 67% of the total debt issued. Another $5.2 billion in assumed debts from the old Clear Channel, representing 23% of the total debt, and finally a $2.31 billion bridge loan that was later converted in a $980 million bond offer and a $1.33 billion of riskier bonds known as paid-in-kind toggle.
In 2006, Clear Channel, the largest U.S. radio broadcaster, said the BOM and THL partners complete their $17.9 billion buyout. The buyers valued the transaction at $24 billion, including debt. Shareholders and acquired company received $36 in cash for each share of Clear Channel common stock they hold. The average closing price was $29.99, and the premium of stock was 25%. The settlement included an option for shares to be exchanged on a one-to-one basis for CC Media Holding and Cooperate stock. The enterprise value higher than the total value of the transaction. These valuation multiples corresponding the year 2007 were calculated assuming the price of $35.21 stock, closing price as December 4th, 2007.
When Bain Capital and Thomas H. Lee announced their intentions to acquire Clear Channel, regulators were forced to take note of the deal. Thomas H. Lee Partners was a partial owner of Univision Media and was a partial owner alongside Bain Capital of Cumulus Media Partners. Therefore, regulators needed to consider these private equity owners as established players within the industry. With this in mind, regulators and lawyers reviewed the deal to ensure fair competition would remain and ad rates would not be driven up. In February 2008, the Antitrust Division of the Department of Justice cleared the deal, with the provision that Clear Channel's radio stations in Cincinnati, Houston, Las Vegas, and San Francisco must be sold. Tax and accounting issues in the transaction. For tax purposes, the holding company, CC Media Holdings, created a subsidiary, MergerCo. MergerCo was to acquire financing to buy out Clear Channel shareholders. Afterwards, Clear Channel will become liable for this debt once it acquires MergerCo immediately. The associated tax law says that the merger of MergerCo into Clear Channel Communications will be disregarded for federal income tax purposes. This also allows the transaction to be treated as an acquisition of Clear Channel by Clear Channel Media Holdings. Furthermore, any Clear Channel shareholder that elected to swap their Clear Channel shares for Clear Channel Media Holdings shares would be treated as a founder of Clear Channel Media. As a result, no gain or loss was required to be recorded by tax code. Shareholders were able to benefit from this, regardless of if they traded all of their shares or just some. This is because the shareholder was effectively terminating their proprietary interests in Clear Channel. This means that in the transaction, shareholders were not required to declare capital gains income on the excess value they garnered from the transaction. With high multiples and a very high leverage ratio, it is clear that the newly founded CCMH was highly levered. The interest expense coverage ratio shows that using EBITDA to pay off debt was not a viable option, as it did not cover the interest expense. Because of this, debt would slowly continue to grow. After several delays, Clear Channel was eventually acquired by Bain Capital and Thomas H. Lee Partners. Since the acquisition, Clear Channel Media Holdings has renamed itself iHeartMedia Incorporated. The estimated enterprise value of the company is now $20.54 billion, significantly lower than the price paid by the private equity firms. Thank you very much for listening to our presentation.